everyone, welcome to Options Discovery on John Loting Loses the Spread. My name is Esma Awas and I'll be your host throughout the series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In this episode, we'll be exploring the strategies behind option strike price selection. Later in the episode, I have a chance to sit down with Jermal Chandler, a seasoned options trader and host of Engineering the Trade, to talk about the science behind selecting a strike. Let's start this episode by talking about what a strike price is. For those who don't know, the strike price is the predetermined price at which a specific security may be purchased or sold by the option holder until the expiration date of the options contract. Strike prices are typically set by different exchanges like the New York Stock Exchange or CBOE. Often, strikes are determined by the fair market value of the underlying shares. The fair market value is an asset's estimated value if it were sold today in the current market. Knowing what a strike price is in an options contract is vital to understanding the value of an option. To get a better idea of an option's value, we can talk about an option's moneyness. Moneyness relates the strike price to the price of its underlying asset. Moneyness describes the intrinsic value of an option in its current state. Options can be considered in the money, at the money, or out the money. Call options are considered in the money when the strike price is below the share price of the underlying stock. They are at the money when the share price and strike price are equal. And as you may have guessed, call options are out the money when the strike price is above the share price. For put options, it's the other way around. In the money puts occur when the strike price is above the share price. At the money puts have an equal strike price and share price. Lastly, out the money puts have a strike prices less than the market price. Once a trader understands how the strike price relates to the moneyness of an options contract, they can select which strategy they'd like to use. A trader who is bearish on the underlying stock can opt for an in-the-money put, assuming that the stock's price plummets. On the other hand, a trader who is more bullish on the underlying stock can opt for an in-the-money call, assuming that the stock will gain in value. Another factor that a trader should consider when selecting the appropriate strike price is implied volatility. Options with strike prices that are at the money are the most sensitive to implied volatility changes, while options that are further in the money or out the money will be less sensitive to implied volatility changes. Traders can analyze volatility using measures like the VIX to select the right option strategy. In periods of high implied volatility, traders can consider selling strategies like covered calls, naked puts, and short straddles. In periods of low implied volatility, traders can look at buying strategies like buying puts, calls, and long straddles. This week, we're lucky to have Jermal Chandler, the host of Engineering the Trade, where he shares his insight into what's happening in various equity and futures markets. Jermal is also a veteran derivatives trader, and he'll give us more insight on strike price selection. Without further ado, please enjoy this week's interview with Jermal Chandler. All right, welcome to another episode of Options Discovery. Today, I'm sitting down with Jermal Chandler, the host of Engineering the Trade. Jermal, can you give us an overview of your background and how you got to where you are today?
Oh man, that's always an interesting question because I definitely don't have a traditional sort of inroads to this background in doing financial stuff. So I was a chemist. I did chemistry as an undergraduate student, and then I did a master's in material science engineering. And I have this basically former career where I worked in labs. I did research. I have published papers that are out there under my name. And I basically decided to pivot because I wanted something different. I was looking for a different challenge. And so I jumped into the world of options trading, mostly because at the time I was still a graduate student and moving into basically the ground floor is trading equivalent pay. Really wasn't that much different. And I was really interested in trading. I still loved science. I still do to this day, and math. And actually, a lot of those things that I learned, I still apply on a day-to-day basis, to be totally honest. But yeah, I jumped into options trading. I worked at a firm, Peak Six Investments here in Chicago. And I worked there for 9 years. And I started off as a trading assistant. And eventually, after a certain amount of time, like anywhere from 6 to 9 months in, eventually, if you've done well enough, you get a portfolio. And so, yeah, I had a portfolio with them for 2 years, various different trading sizes, I should say. I started out like 250,000, and then you progress, as long as you're doing well, you get to progress and move forward after every review. So it was about 500,000, and then 1 million, and then 2 million. And but to be totally honest, I did well on my portfolio, and then I had times where I struggled. But I would say I learned the most by working with senior traders and helping them trade. And when I ended up having a collaborative effort to work in a group, I jumped all over that chance, and I worked in a group with a couple of other senior traders. And it just so happened this was around 2008, 2009, which was really volatile times in the market. And I have to say that was the lasting impression. Like, I learned so much working with them. I ended up working with them for an additional 5, 6 years. And that was probably the best experience that I had there.
So let's just talk about the main topic of today, which is option strike price selection. And we can just start off with the very basics. Can you give us an overview of what a strike price is in an options contract and why it matters to a trader?
Sure. So a strike price is essentially the area in a stock where the action is taken at, right? If you are long a call, let's say, for example, at a certain strike price, once it goes above that strike price, then your option is what's considered in the money, right? And so you got to understand what in the money is, what out of the money is when it comes to strike prices selection. But also, selecting a strike price really depends on the type of trade you're doing. I mean, you want to have essentially probabilities on your side, and this is what we talk about a lot at Tasty Live and with Tasty Trade with our brokerage. You want to be able to look at the different deltas, right? The delta of your options. And so understanding what once you understand what the delta is, that will help you kind of determine what strike price you choose based on your expected outcome for your type of trade. And I'm being vague because there's so many different ways you can go with it, right? Like, if you're selling an option, you usually want to be more of an out of the money type of option, which is usually probably a strike price that's further away than at the money, because those have a lower chance of potentially finishing in the money, and you have a better chance if you're selling those for those options to expire worthless, which is really what you want when you're selling options. So there's a multitude of ways you can look at it, but understanding like a strike price in general, just knowing where the action takes place on a particular stock at that specific strike price.
And I guess to be a little bit more specific on that, how does the moneyness differ maybe for a call versus put option?
Oh, it differs in the sense that when you have a call option, if the stock is above your strike, then that call is in the money, right? Which could potentially be good if you're long it and you want it to go up. But if it goes down and it goes away from that strike, then you're out of the money at that point, right? But if you have a put option, if the stock is below that strike price, then that option is considered either in the money in that situation, right? And so depending on the type of trade you have, that's when you want to be aware of whether you want the option to be in the money or out of the money.
And I guess to go a little bit deeper, how does an options contract's time to expiration factor into an investor's decision when they're selecting a strike price?
Oh, that's a big one because it really depends on whether or not your option is eventually going to expire, right? Like, that's the most important thing. You want to know how far away from expiration your option is going to be. And this is where time decay comes into effect for options, right? Like, time decay, the most important thing to understand is that options eventually will decay over time. And that means their value decays over time. And there's like sort of, when you're looking at what's called the fate of the option, which determines whether or not how an option decays over time, there's a sweet spot at some point in that curve. We've done a lot of research to look at this. And usually for options, that 45-day to 21-day window is a very interesting time decay window for options, right? So if you're selling options, we often look at selling options at a 45-day window and eventually look at the 21-day window to either close that option or roll it to the next expiration. So, if you have options that are going to expire in 0 to 1 days, obviously that's really important to understand where the moneyness is, whether they're in or out of the money. But if they're further out, say 30 days, 45 days, then you have an idea of how much longer you have before your option eventually decays.
And let's talk, I guess, a little bit more about risk. And I know you were talking about that in the introductory part of our conversation. So let's just say that an investor they've identified a stock they'd like to make an options trade on. How does their risk tolerance come into play when they're evaluating these different strike prices?
Oh man, I mean, I guess everybody's a little bit different. It all depends on the amount of money they have available, right? But it really depends. So say you have a $50 stock and you're interested in getting long that stock. One way to do it, of course, is buying 100 shares. That would be $5,000. I think a lot of people would say, "Oh, I don't know how much I want to do that," or some people say, "Oh, sure, that's fine. I'm willing to handle that," and you're willing to deal with the ups and downs of that stock. Another way you can put on the same type of position is selling a put in that $50 stock. And say you're interested at $40, right? That you would be willing to buy 100 shares. If you sell the 40 put, you're able to collect the premium in the meantime if the stock doesn't go below that strike price and puts that option in the money. But even if it does, the worst thing that happens is you eventually become an owner of the stock for 100 shares because again, one contract is equivalent to 100 shares. So that's another way to do the same type of trade. But a lot of people are very risk averse, right? So most people are looking at the idea of, well, this is a cheaper way to do the same type of trade, but I don't want to sell a put because I'm worried about it going in the money. And so that's the interesting thing about risk, because most people will say, oh, I can put on this 100 shares and I can leave it alone and never look at it and it's fine. But those same people are not willing to sell a put and do the similar type of action eventually with the stock. So it's interesting. I think everybody's, risk and comfort level is different. But I think once people start to really learn more about options and understand how these tools can really sort of enhance your portfolio, they'll be able to understand risk a lot more.
So I know you're talking about that a lot of traders are, I guess, risk averse. What are some strategies that a trader would use if they're the opposite, if they're willing to take a lot of risk?
I would say, the idea of selling puts, selling a strangle is considered very risky, right? Because you can sort of, I mean, if the stock moves a lot in either direction, that's one where you could either see substantial risk to the downside or unlimited risk to the upside. So that's probably the biggest one, selling a strangle. The idea of just selling a call option. I mean, these are the real riskier trades of options that I think people talk about. But the biggest thing is I think people don't know options enough to know what to expect. And I think on any trade, you have to know exactly what's your best and worst case scenarios. That's the number one thing options teaches you, right? Like the idea of understanding the risk of your trade. There's risk in buying a call option. I mean, I think a lot of people assume like that's not too bad of a trade, but the fact remains is we just said earlier, options mostly decay. So if you buy a long call option, I mean, at that point, your biggest risk is theta. And every day that goes by that option doesn't go up, in this case, because we're long the call, you're going to lose money. It's just going to sit there and decay. And so that's a risk as well. But I think a lot of people don't look at it that way is because it's just a different type of risk than just selling an option, right? So that's a huge part of the game. But I think once you start to really understand your risk and your every position has risk in every different trade, that's what you start to change and become more seasoned.
So I guess one of the main takeaways is the risk profile isn't necessarily a set category. It's kind of dependent on each trader and what they're comfortable with, I guess. So I
Oh,
have a few more questions about risk. Tell me more about the risk reward payoff an investor has when trading an option. How would a trader's risk reward payoff change depending on their selection of maybe an at the money strike price versus an out the money or in the money strike price?
yeah. So I'll keep it simple, and we'll just look at it from one trade standpoint. One of the things that when you first get in the game, you try to find the easiest way to buy make fast money, as they say, right? A lot of people will look at sort of out of the money options because those are the ones that cost the least, and most people are looking to buy. As we said, most people are familiar with once they start to learn a little bit, buying an option is an easier thing to understand and cope with than it is selling an option. So most people will look like sort of an out of the money call, like a 30 delta call, and buy that, right? Or buy a call spread that's further out of the money with the hope that they can buy it for cheap and all of a sudden make, XYZ amount of money, right? But the truth is a further out of the money option, they have a lower delta for a reason. I mean, they have a lower percent chance of ending in the money, right? It's not to say that it can't. It's just that you always want to have probabilities on your side, like we talked about. So I think there's another way to do a similar trade, but does take on a little bit more risk. You could do a call spread that's in the money. You could buy like a 60 delta call and then sell a 30 delta call. Say it's $10 wide call spread. In that case, yeah, you're taking on a little more risk because you're paying more premium, but you do have a better chance of your options remaining in the money, right? So it's just in that alone, buying something that's a little meatier versus buying something that's not as expensive but further out of the money, hoping for the big move. I think therein lies the conundrum. You're hoping for a big move when it's further out of money versus being in the money and planning for it to move and still having the wiggle room to make that trade.
So I guess that's a good overview of like the risks that a trader can face. So like let's say that, a trader doesn't evaluate these risks properly and they end up picking, I guess, the wrong strike price. What would happen to them, or like what's the main consequences that they would face from that?
How do you mean wrong strike price?
Like let's say they're trying to buy a call, right? And the strike price they select turns out to be, I guess, out of the money, or doesn't when it expires, it doesn't give them like the return that they wanted.
Oh yeah, well that's a good point. And if we just talk about it from buying a call, I mean, if you buy a call, that's the out of the money and finishes out of the money. Well, you're going to lose 100% of your profit, right? I mean, or I should say 100% of your investment, just from buying an out of the money call that expires worthless. That's one of the bigger things that people have to understand about options, right? And again, like we said, that's risk. It's not the same risk as being short a call and then having a huge move, big squeeze move like we've heard of before with short squeezes. But just having that long call and losing all of your premium that you paid, that's risk too. And so you lose, everything that you put into that. That's not exactly what most people sign up for, right? I mean, most people sign up for the idea of what happens with stock when you're long 100 shares, and sure, it goes down $10, you might lose $1,000, but you still have majority of your investment. Whereas in this situation, you long that call, you can lose everything. So that's something that people need to be aware of.
And I guess, going back to that same situation, how could maybe a trader adapt to, I guess, different market conditions or maybe implied volatility just to avoid those kind of situations?
Yeah, that's a great question. And that's essentially what we talk about at Tasty Live all day long, 7 days a week, every, 252 days a year, adjusting to market conditions. And so one of the things we do talk about selling volatility because of the fact that there's one thing that's given. All stocks don't always go up. All stocks don't always go down. But for the most part, volatility lays kind of dormant. It eventually spikes, kind of like what we're seeing right now. And then at some point it recedes. There's a mean reverting quality to volatility. So we're always looking at situations where we're waiting for volatility to spike. We're waiting for probabilities to be on our side to be able to sell volatility so that it eventually collapses. And that's the way we try to talk about majority of the trades that we do. So it's, again, we talked about the idea of selling options, and that's sort of a hard concept for people to wrap their mind around. But when you're selling options at times when the market is creating opportunities for selling you volatility, it's a very different situation.
I hope you learned a little bit more about option strike price selection. I want to say a special thank you to Jermal Chandler for taking the time to talk with us. Thanks for watching, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.